Hey everyone, my name's Andy. My channel's Finding Value. Today we're going to go into the comment section. I'm going to make comments on your comments, give you my financial opinion. And looks like I've got some questions or some statements on inverted yield curve and housing market, real estate, stuff like that. So I'll give you my opinions here. So one of the opinions here, let me zoom in so you guys can see it. It says an inverted yield curve predicted recession every time in history, and it is inverted as hell right now. Be smart. What I will say is the inverted yield curve doesn't predict anything. What it shows us is the market conditions for something to happen. So I said the yield curve does not predict anything. It shows you that the conditions of inflation exist. It does not tell us how long it will invert and stay inverted, etc. So a yield curve was inverted for basically all of the 1970s. And we had very large real negative rates. So how long will this yield curve stay inverted? And that's where, Scott and myself, we go in and we dive into a lot of these videos, looking at delinquency rates, looking at checkable deposits, looking at what we think is what matters, where you could see potential foreclosures, potential deleveraging in the system. It's the deleveraging and the destruction of credit that is the problem, not the inverted yield curve. The inverted yield curve is, think of inflation coming into the system. But if there's nothing to really break, or if there's nothing to deleverage, then I don't think the slowdown will be that dramatic. So what we're trying to balance here is we're balancing the really good, we'll call it fundamental structural market conditions in the commodities sector versus the liquidity in the system. Now, I know that they raised interest rates dramatically and quickly and made housing a lot less affordable. And housing is a driver, it's one of the drivers for inflation into the system. Credit expansion is what I'm talking about. And whenever we increase that credit expansion, or whenever they do stimulus like they did and it gets into the hands of people, the yield curve inverts when inflation's in the system and bondholders sell off dramatically on the short-term yields. That is what inverts the curve. So it's not that it predicts a recession. It's the market conditions that always happen after you get a good dose of inflation. It's like the hangover, so to speak. But the hangover doesn't have the signature of a housing market crash. So I don't think we're going to see some gigantic crash in the system unless we get some sort of delinquencies, foreclosures, and a housing market crash. If you get that housing market crash, I don't think we're within a year of it. So it doesn't predict when this will happen. And I look at the other signals to see what this could look like. It could be a 2000 to 2001 recession in stocks, and that might have already occurred. I don't know. We'll see. So I'm not as bearish as other people. And you go look at all these charts, and I can tell you the charts look absolutely fantastic. So maybe we have an inflationary recession, which is stagflation to some degree. And just because we don't have inflation, which is a lagging indicator at this particular second, that inflation can come back with oil going higher and a lot of these commodities going higher. It doesn't mean it's over with. We didn't end this in a gigantic supply, hyper supply in oil or anything. There's no supply in any of these commodities right now. We are at very low inventory levels. And I know that those inventory levels could have been driven to those lower levels by stimulus in the system in America. But there's also stimulus happening in China and in other areas of the world, which may increase the demand for commodities and push commodity prices higher. It's not It's not inverted yield curve, go run for the hills. It could stay inverted for a long time, and it could be inverted for a while. And they may need to increase interest rates and keep them at a high level to keep the inflation from the housing market at bay. That's what might happen. Now, I'm coming back down here. There's another one I wanted to hit here. It says, not often do I disagree with this channel, but here I do. It says, charts are not telling the whole picture. History tells us that high inflation has always been followed by a recession, without exception. Once the recession hits, the Fed may cut, at which point all bets are off. I'm still holding energy companies, and when the recession comes, I'll buy more. It's a 10-year trade, in my opinion. I agree that generally a recession could come with high inflation. I'm kind of curious what you guys are using to measure a recession by. We've got very low unemployment. We've got delinquencies at the lowest it's ever been. We've got checkable deposits, which is cash in the system by the lower 50th percentile of wealth. It's at all-time highs. What are people looking at and so worried about for this recession? Where is it going to come from? Now, the stock market's going to go down because we had interest rates go higher. What if the market is a lot stronger than what most people think, and that the recession is basically already behind us? I'm just giving you, it's not my opinion, I'm just giving you what could be. It says, when in history have they pumped over $4 trillion into the system? The other inflation events were from bank lending and subsequent real estate bubble bursting. This time is massive government spending and money going directly to people. Yes, there will be a recession when we overbuild housing, just as history tells us. And I agree, we haven't had that overbuild in housing yet. And we would be stuck with a hypersupply phase. So a hypersupply phase in the real estate market, this is how you tell if you're in a hypersupply phase. If you decline the interest rates, if you cut the interest rates in half from where we are today, and you're in a hypersupply phase, the demand for housing would still not be there, even if you cut rates in half. You would have too many homes. Now, if we were to cut rates in half, I am willing to bet that the housing market prices would stabilize and go higher if you cut the interest rates in half. It means the demand is there. It's just not affordable at this time. And for the Federal Reserve to keep that inflation at lower levels, they're going to have to keep the interest rates high. That's what is most likely going to happen. It says, I'm not sure how you've come to that conclusion. There is no way house builders will start flooding the market with supply. No chance. Inflation is high and we will remain high until a recession. So what causes a recession, guys? It generally comes from the housing market, generally. Now, things can slow down, but I don't think it's going to be like some blowout crash. We could have a recession technically, and we already kind of did with a declining GDP number, but generally in a housing market boom phase, more jobs are created, unemployment's very low, et cetera, et cetera, et cetera. So I'm not so sure that this recession that people are worrying about is going to be some like blowout crash. That's maybe the difference. I'm not saying we can't have a recession, but what I am saying is that if we get a recession, I don't think it's going to be some blowout crash. That's where my mind is at. Everyone else, they think the housing market's just going to explode and everything's going to just crash like heck. If that is the case, we should see more inventory, more delinquencies, more foreclosures, more deleveraging in the market. And I just don't see that yet. It's not there yet. It says cost of living is high and will remain high until a recession and potentially longer. The cost of living was high all the way from 1945 to 1980. And that's what I think is coming is cost of living is probably going to cause a recession, and which will be a stagflation, but it's due to the limited amount of commodities in the system and the limited amount of houses to buy. It says people are not buying homes. Yeah, they are. If you go and you look at the commercial real estate loans, or commercial bank real estate loans, I should say, So here's real estate loans, all commercial banks. It's going up, guys. Where is this recession? If people aren't buying homes, why are real estate loans by all commercial banks going vertical? Why is it doing that? Why are we going higher? Where are you guys getting your data? Where are you getting your data? Real estate loans, all commercial banks are going higher. So is $5.328 trillion not higher than 4.647 in 2021 here? This is all 2022, and this latest data is from November of 2022. Now, November 28th, 2022, we've had increasing amounts of real estate loans from all commercial banks. But people aren't buying homes, apparently, even though we've got more and more real estate loans from all commercial banks. So where's your data? This here, people are not buying homes, is false. We are at average for new home builds, and people are buying homes. That's why our real estate loans, and if you look at the percent increase here from month to month, this looks like a gigantic increase from this level to this level. That's massive. It's more vertical than almost anything else on this chart, outside of maybe the mid 2000s. Or mid 2000s here. I don't know. I think that comment is just false. They're trying to stay afloat. The Fed will not cut rates unless they have no other choice. The Fed will cut rates. They have to. The market's going to force them. I don't think they control everything, guys. If they want to control interest rates, they're going to have to do QE. The market, if the market doesn't have the inflation, it's going to bring down interest rates. And I don't know how they're going to hold them up there. It says, in that choice, as far as I can tell, cut rates or default on national debt. Very few of us have invested or even lived through high inflation. But this has happened many times in the last 5,000 years. I agree. It says, you're missing the point. We have never had a meaningful recession that didn't start with a housing crash. The inflation from the past you're talking about comes from bank lending against new homes. If you follow the business cycle, it's the same as the real estate cycle. When we overbuild, there's a crash, and then we go into recession. Totally agree, yes. I'd say it's quite obvious from that comment that you are missing the point. The inflation from the past, I'm thinking, does not come from over-lending on homes. What a ridiculous statement. I can only assume you have no idea how high inflation affects an economy. Yes, it comes from the inflation comes from credit expansion, guys. The majority of money is created from fractional reserve lending by the commercial banking system. It comes from this. This is one of the largest drivers of loaning in the system is real estate loans. And when you see these, whenever they go down like this, that is really, really bad. And that happened in 2009 all the way down to 2013. Here was another one, but we fictitiously stopped that market there. And then it just started ramping like heck. That's your commercial loans in the system. This is deflation there. That's why they printed all that money and propped up a bunch of crap. But this doesn't look like it's slowing down. It looks like it's accelerating. So that's my opinion. So what happened in 2008 then? How about the 70s? Even the Great Depression was preceded by bad bank loans on farmland. It's generally demographic driven. When you have a large demographic, for instance, the baby boomers in the 70s, yeah, you're basically saying yep, you must be new here because you said I agree with most of what Andy says, but if you in fact disagree with what I'm saying, then you disagree with Andy's thesis. Agreed, yep. What is the inflation you're thinking of exactly? Do you understand the only two ways of creating money are bank lending and monetizing government debt? Agreed. Yes, that's correct. That is correct. And I like all these other guys, like Elliott Wave, dude says oil has a big leg down in the near term. I want in all of these. And maybe that's the case, guys. I'm not saying that it can't happen, but things are breaking out. But that's my opinion there. I wanted to tackle those two. I don't see where the weakness is in the market necessarily. I know everybody says high inflation, then all of a sudden a crash is going to ensue. We could see weakness in the market, potentially. We might not. It all depends. We had an increasing interest rate environment at the same time. We had an increasing demographic coming into home buying years in the 1970s, and it didn't slow the housing market down very much. It still went through its demographic and came back down and then went through another increase in the demographic. So the increase in the demographic is here. And I think it lasts for some years until the homes are built. We went into hypersupply phases where inventories increased above 10 months both times in the 1970s. And that's what caused the crash. So that was the 1970s and late 1980. Those crashes. The demographic ran out, and then we had lower growth rates ever since 1980 till about 2020. But that's the history there, and that's what I'm seeing. It doesn't mean that we can't have a small recession. I just don't see the big one that people are calling for, like a 2008 crash. That's the one I don't see, at least not yet. If that was the case, you would see foreclosures really starting to kick up, which is delinquencies. We don't see delinquencies. The delinquencies, Fred delinquencies, is what we can look for. There's your Fred delinquency rates. We go to delinquency and delinquency rates on all loans. So delinquency rates on all loans. And this is at November 23rd, 2022 is when it was last updated. And here it is coming on up. It's taking its sweet time. And we are at a very low level. Now, could we be at a level that is like in 2005? We could, or maybe 2006. We could, but if we see this turn around, we still have another year or two or three before it crashes into a recession. So what I'm saying is delinquencies kind of have to get hold and they have to like work its way through the system, but it takes time. It doesn't happen immediately. So we can see an inverted yield curve, but that does not necessarily mean that we're going to get a crash immediately. We could have, in 2005 is when this thing kind of bottomed out, or 2006. If we go back and we look at crude oil, and we go back to 2005 and 6, so here's 2005. Crude oil was at $50 and it went to $150. We still had a three-bagger in crude oil in 2005-ish. If it was 2006, in 2006, we were at $70 and it still went to $150. So, I'm not in the camp that this thing doesn't have anything left in it. Sorry, guys. And here we are in basically the Livermore accumulation cylinder. Somewhere like that. We have a little lead in, then it's 1, 2, 3, 4, 5, 6, 7 perhaps, and maybe we'll get the big run. Maybe we don't. I mean, I don't know the future. It's just, and I don't think anyone else does, but it's hard for me to believe that we just barely broke out of this thing and that everything's just going to come crashing down. Could this pull back further to a $60 or $50? It is possible that it could do that. And that would be a full retest of this breakout. It's very possible. Am I calling for it? No, not necessarily. So that's what I've seen in the markets, guys. That's what I've got. If you guys like this content, give me a thumbs up. If you're interested in learning about commodities, definitely search for finding-value.com. Use the word discount if you want to become a platinum member in the coupon code. And we'll catch you next time. This is Finding Value.